What if I told you that you could build long-term wealth with just 3 investments? No stock picking, no stress, and no hours spent researching companies. Today, I'm breaking down the only 3 ETFs you need to build wealth, even if you're a complete beginner. Stick around because I'm also sharing some simple tips to avoid beginner mistakes and maximize your returns. Before we jump in, let's make sure we're on the same page. An ETF, or exchange traded fund, is like a basket of stocks or bonds you can buy with one click. Instead of buying hundreds of individual stocks, an ETF gives you instant diversification and typically at a very low fee. This is why ETFs are the go-to choice for long-term investors: simple, affordable, and effective. All right, ETF number 1, and the foundation of almost any portfolio, is a total stock market ETF. This ETF invests in nearly every publicly traded company in the US, from giants like Apple and Microsoft to smaller companies you've never heard of. Examples: VTI, Total Stock Market ETF. Schwab US Broad Market ETF. iShares Total US Market ETF. Why it matters. A total market ETF gives you huge diversification, exposure to long-term US growth, very low fees. Historically, the US stock market has returned around 7 to 10% per year over the long run. A total market ETF lets you tap into that without needing to pick individual stocks. This should usually be the largest part of your portfolio. ETF number 2 is an international stock ETF. Why? Because the world is bigger than just the US, and adding international stocks reduces risk and increases diversification. Examples: VEMEC Vanguard Total International Stock ETF. iShares Total International ETF. These funds invest in companies all around the world: Europe, Japan, Canada, emerging markets, you name it. Why it matters. Different countries grow at different times. When the US slows down, international markets may be rising. Owning both smooths out your returns and protects you from being too dependent on one country. A common beginner allocation is around 20 to 30% international, but adjust based on your comfort level. ETF number 3 adds stability to your portfolio, a bond ETF. Stocks go up long term, but boy, do they bounce around. Bonds help balance your portfolio and reduce those stomach-turning drops during market crashes. Examples: Vanguard Total Bond Market ETF. iShares Core Aggregate Bond. If you're younger, your bond allocation can be smaller, maybe 10 to 20%, because you have more time to ride out volatility. If you're closer to retirement, you'll likely want a higher percentage. Think of bonds as your portfolio's seatbelt. You might not feel it working, but you'll be glad it's there when things get rough. So how do these 3 ETFs fit together? A simple beginner portfolio might look like 70% total US ETF, TF, 20% international ETF, STAS, 10% bond ETF. Want it even simpler? Many investors go with something like 80% stocks, 20% bonds, then split the stock portion into US and international. The beauty of this 3 ETF approach is that it's easy to manage, super diversified, low cost, proven over decades. No need for complicated strategies or picking the next hot stock. A few quick tips to maximize your success. Tip number 1, stay consistent. Invest on a schedule, weekly or monthly, no matter what the market is doing. Tip number 2, ignore the noise. News headlines try to scare you. Your job is to stay calm and keep contributing. Tip number 3, focus on time in the market, not timing the market. The longer you stay invested, the more your money grows through compounding. Keep fees low. ETFs are already cheap. Stick with well-known, low-cost providers. And there you have it, the only 3 ETFs you need to start building wealth today. If you found this helpful, hit that like button, subscribe, and let me know in the comments what investing topics you want me to cover next. Thanks for watching, and remember, simple investing is powerful investing.